Hi traders, welcome back to part 2 of Becoming a Trader Discovery Series. Yesterday, or the last video that you watched, we covered the basics of a trade. Basically, what's the difference between technical, fundamental analysis? How do you make money from an actual trade? How does that look? Reward risk ratio versus strike rate. We covered that. We also covered the details of how does an actual candlestick look? What does that data represent on a chart? Now today we're going to take that knowledge going to take it a step further and learn exactly what the core principles are for trading. The 6 core principles is what I call them, right? We're going to incorporate those. We're going to combine them together using what I call the alchemy of trading to teach you your very first trading strategy. So that's it, right? This is people pay big money to learn trading strategies that are profitable, that are effective. By the end of today, you're going to be confident to be able to go out and actually at least understand the theory of how to place a trade, right? So that's super exciting. Let's jump into the charts. We're going to begin with those 6 core principles, and then we're going to have a look at a few trades and see how they would have played out on historical data. Right? I'm sure you'll be pretty impressed with how incredibly effective these strategies are. Now, another thing I'd like to add there is a strategy must have criteria. There must be a checklist, right? Like anything that you're doing in life, there are certain rules to the game. There are certain rules that you need to abide by. If you were, whether it's a sport or a career or you're an airline pilot, there's a checklist that you go through. You need to be doing these things consistently every time. What trips most traders up is that they go in and they trade what they think, not what they see. There's a saying in trading, trade what you see, not what you think, right? Meaning if X, Y, Z criteria are met, then A, B, C. This is very mechanical trading, right? Which is why I firmly believe that anybody can learn how to trade using these mechanical principles, and you don't need to be a genius. All you need to do is follow a checklist, which is what we're going to learn today, right? So let's jump into the charts and we'll start with those 6 core principles. Okay, so let's begin with this chart here. Again, there's a pound Aussie chart. It's a Forex currency pair, but it really doesn't matter. First core principle is market condition, right? So market condition there's 3 different types to market condition. We're going to fly through these. This is going to be express, right? So I'm not going to go and fill it all out, but write out the description for each of them. Grab a pen, grab a piece of paper, and just follow along as we go. So there's 3 types of market conditions. 2 types are tradable, right? So the first market condition is trending. So a trending market, right? That's our preferred market condition, and that's the strategy that we're going to learn to trade today, right? With the first strategy that you learn. There are other strategies that you can capture, other market movements. The other 2 are ranging and choppy. Now, we'll cover what the 3 of them are, but we'll begin with trending market. Simply what defines a trending market is where the highs and lows are. So we can see this is a high, this is a low. Price has kind of just zigzagged its way up here, right? So high, low. Once a new high has formed, so we need at least 3 data points. We need to know where a high is, which generally means there was a low that was prior to it. So this was a high here. How do we know this was a high? We didn't know this was a high until price started pulling back here, right? Because at this point, if we're considering this as a high, price could keep going. It could form a high up here. There's a high, low, higher high, right? Higher low. We're looking at the overall big picture, so we can be ignoring this kind of the small little runs. 1 or 2 candles doesn't really make a pullback. We'd also call this a run and a pullback, and a run and a pullback, right? The runs are with the trend, and the pullbacks are against the trend or counter trend. So high, higher, low. Well, this is a low. The first low, higher high, higher low, higher high, higher low. This is an uptrend. Now, you can also catch downtrends. It makes no difference if it's going up or if it's going down. Now, where we lose the trend is when price comes down low. So higher low, all these lows are higher, that's okay. But now we've formed a lower high. Here was the lower high. Now this came up and did form a higher low, but now this is just what we call an indecisive market, or choppy or indecisive, right? We don't know, because this could go down from here because it's formed a lower high, or it could keep going up because it has formed a higher low. We're unsure. So this here would not be trading conditions. We wouldn't be trading long off any of these candles. We wouldn't be going up because of that. We're looking at that recent high, and it's a lower high. We're going to learn more about that when we get to the strategy. Now up here, this is it. Once the new higher high formed, okay, cool. We're pretty happy with that. We I missed a line here. This one then formed a new higher high and a new higher low, so the trend continues and carries on doing exactly that. So higher high, higher low, higher high, higher low, and so on. Now over here, this is another low, this is a high, this was a similar low, so it could be tread cautiously here because similar lows. We're not looking exactly to the wick. And you can be comparing wicks and bodies and things like that. It doesn't matter if it's coming from the wick or the body, it's just the overall price action. So you can kind of blur your eyes a little bit, glance at the chart. We don't want to get too microscopic, zooming in and things. Like we can clearly see that this is higher than this, the higher lows, right? So this here, very similar. And now what do we have? A lower high here form. Right, so at this time you could have traded long here, but you most likely would have avoided it because of this. The lows seem to be getting lower. If it was a lower low, then it would be the beginning of a downtrend. The downtrend began here, really. So we had this high, just a neutral high, right? We don't know if that was a higher high, lower high. It was higher than the previous trend, and then it had a low here. Lower high, lower low, lower high, and the downtrend continues. This is a big run here. Low, high. Similar low here, and then a new high. Now, and then from there, it just kind of went choppy. So this is what choppy looks like, where it's high, low, high, low, high, low. It's very small. Like you could argue that this is a range here, but this is just what I call sideways or indecisive. So in summary, we've got trending, ranging, which is when it ranges between two bands. So see how we've got this low here, this low here. If these highs were the same and price was just oscillating side to side to side, just kept going up and down, zigzagging sideways, you can also trade that. Not with this strategy, but it is a tradable market condition. The one market condition that is not tradable is choppy, where it's ran with the highs and lows are higher highs, lower lows, higher high, and that's just not tradable. We're not interested in that. So we move on to the next currency pair, or the next asset, the next crypto, or to the next commodity, and so on. We look for another asset. So this is about looking for, not specifically trading one type of asset. It's about finding where the strategy plays out across all assets. It doesn't matter, right? That's the joy of technical analysis. Now, the next market principle, or the core principle, is market phase. Now, I'd already touched on that before, but market phase is when I'm talking about runs and pullbacks, right? The old adage, you want to buy low and sell high, right? It sounds pretty straightforward, pretty simple, but the novice trader typically buys high and sells low. They wait for the price to move, runs up like this. And we see it all the time in crypto, especially with novice traders. Price is running up, and then they FOMO in, and they end up buying at the top as the institutions start taking profits, which drives the price back down. So we don't want to be buying at the tops, right? We want to be buying low and selling high. Pretty straightforward. So run, pullback, and we want to be entering in the early. So we've got, let's just look at maybe this one here, or where's some clean price action? Yeah, let's have a look at this. So this here would be early pullback, because we've got one or two candles here, mid pullback, and then late pullback. Right? We don't really enter anything mid or late. We always want to get in early. So early pullback, that's for the reversal strategy. That's the second strategy you're going to learn in Pro Trader, but we won't cover that today. So this would be early run, because it could still go sideways and fall from here, but we're anticipating there's an early run. This is around here, mid run, and then late run. So for our entry, we'd be looking at getting in somewhere around here, buying low and then selling high. Now, if this trend remained intact, this would have formed a new high, and we could have traded it all the way up and banked some very healthy profit. So the third principle here is support and resistance. Now, support and resistance is, you can have dynamic support and resistance, which is based off EMAs, which we're going to cover in indicators, or you can have fixed support and resistance, which is where highs and lows form. I haven't actually drawn any in here, but we could be looking at where there's a bounce like this, a double bounce. This may form a resistance level, So support or resistance is when you have at least 3 rejections off of a similar price point. So if we have a look here, like we've got a bounce here, bounce here, bounce here, bounce here. That is resistance. Support and resistance is the same thing, really. It's just if it's on the way up, it's resistance. Price on the way down, it's support. Now, what was once resistance can be support. So just because it's rejected on the way up, if it breaks this level, it can sometimes reject on the way down as well, quite frequently. So when we just drew, I've only looked at this little peak here, but if we go sideways, we'll see, okay, great. We've got another rejection here. We've got another rejection here. It did end up breaking it, but it did reject it and bounce up. Over here, it bounced a couple of times, bounced here as well. Very near bounce. And then bounce again. So we can see just by that one little line there, if it's had 3 or 4 more, and we can see this just carries on almost infinitely, right? And price just keeps responding to that level. So I like to say, consider support and resistance levels like rotten floorboards in a 100-year-old house, right? Chances are it will hold, but maybe not. I wouldn't bet the farm on it. So we want to still incorporate this in our trading. So this is what's called stacking confluence, right? Bringing in these support and resistance levels. So stacking support and resistance, your market condition, your market phase, and support and resistance. So those first 3 there, if we are considering that market condition, an uptrend generally continues in an uptrend. It remains an uptrend longer than it doesn't, if that makes sense, right? If we're forming higher highs and higher lows, we're trading with the trend. There's a 55-60% chance that the trend is going to continue further. Now, the market phase is after price is pulled back and we're in an uptrend. It's a good price, so good chance it's going to go up from there, right? 55-60%. Now, support and resistance, if we were to say, if we counted how many rejections this had, 1, 2, 3, -1, so I'd call that a -1 because it didn't hold, so that would be back to 2, 3, 4, 5, -1. What are we at? This is +1. I'll consider that one. Look, like, let's say 7 out of 10, 8 out of 10 times it does hold, then stacking that together, that's what we call stacking confluence. Any one of these indicators or any one of these principles alone doesn't necessarily build a strategy, and they're not solid enough just to consider that one core principle to be able to trade off of, right? To comprise an entire strategy. But when you combine them together, this is where your strike rate increases. This is what makes and determines a profitable strategy. So moving on, next one is indicators. So indicators are one of those things that many novice traders just layer 10,000 indicators on their charts, and they hope that one of them is going to give you an entry. Now the thing is, there's so many indicators out there that many of them become contradictory of each other. And if you're a trader that is subject to confirmation bias, right, when you're going out actually looking for a trade or a setup because you want to trade, or if you're somebody who's fearful, right, there's kind of the 2 types. You're either a fearful trader and you don't want to enter if you see a negative, which isn't really present, or a confirmation bias trader that wants to take as many trades as possible and just looks for, goes through this stack of 15 indicators, only focuses on the 3 or 4 that say that, hey, there is a trade here, and then they take the trade, ignoring the rest, right? Versus the other trader who will look at 15 indicators, 10 of them or 12 of them or 13 of them will give you the green light, and then they also don't enter because there's 2 that are saying don't go ahead. So too many indicators is just going to be problematic. And there's really only 1 or 2 indicators that I use, and they are EMAs. In the next video, we're going to go through your entire TradingView setup, how to actually execute a trade. That's what tomorrow's or next video's session is going to be centered around, right? So just follow along for now, and then we'll get you all set up in the next video. So all indicators can be found here, and you can just type them in here, moving, average, exponential, but we'll get back to that. So over here, the EMA that I use, there's 2. There is the 50 EMA and the 20 EMA. That creates these kind of squiggly lines here. The 20 EMA is based on the close of the last 20 candles. So it's just an average close price. So if you see it, it tracks price along quite nicely, and it just takes an average of the price. So you can see it'll always track along. If price moves down quite aggressively, it'll trail along slightly behind there. Now, the 50 EMA does the same thing. It's just a little bit behind. Now, these are great, what we call dynamic support and resistance, because oftentimes price does reject them, or at least the zone between them. So we can see here, bounce, 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 bounce. Very similar to what we saw with that support and resistance line. Now, price action patterns are, we won't go into all of them today, but these are your triangles, wedge patterns, head and shoulders patterns, and deceleration. So deceleration is what we want to be focusing on today. Deceleration is when we see price kind of slow down, right? We want to be entering in, how do we know that when a pullback has occurred? Let's just turn these off for now. When a pullback has occurred, are we going to take an entry long, right? So this bearish engulfing candle, we'll actually cover both of these together. So candlestick patterns are the specific candle, or the candlestick formation it can be called, right? As we discussed this on the previous section, the previous video, that the size, like this big candle here, if you remember what that's called a bullish engulfing, because it's a big green candle. Big red candle is a bearish engulfing, bullish engulfing, bullish engulfing. This one here is a doji. This one's a big bullish engulfing, and then price turned around and pulled back. So we want to see deceleration. We want to see ever reducing smaller candles forming. The example that I used was throwing the tennis ball up in the air, right? It'll accelerate out of your hand. It'll reach full speed shortly after leaving your hand, midway through its flight. Once it approaches the top, it is stationary for a moment, but as it approaches the top, it'll start decelerating. It'll slow down. Right before it becomes stationary, it'll be going as slow as it will in its entire journey. Then on the way back down, it'll accelerate and reach top speed back when it reaches your hand. It makes sense, right? So that's what we want to be looking at in the charts here. We want to be looking and identifying the deceleration. Here's some great examples. This one over here, fantastic deceleration price. Full speed, it slows down, smaller, smaller, smaller doji, and then it popped to the upside, right? We don't always get it, but it is quite, it is one of the critical criteria when placing a trade. So you may miss out on trades just because there was no deceleration. That can sometimes happen. So over here, another one, prices were forming these low test candles. Now the candlestick patterns are, or candlestick formations, these we incorporate these into our trading because, again, within that one candle, that can give us an indication that price is slowing down. So deceleration can be a price action pattern, but based on the candlestick formation. So that kind of makes sense, right? So candles getting smaller, a low test. So we're going to rattle off a few of them. First one here is a low test candle. Low test is where it pushed price down and then it drove price back up within that single candle, whether it be a daily, 1 hour, it doesn't matter. So doji candle, again, means that price is an equilibrium between the bulls and the bears, the buyers and the sellers, meaning that if a doji occurs at the end of a run or at the end of a pullback, it's a reversal type candle. Some are continuation, some price action patterns are either continuation price action patterns, and some are reversal price action patterns. A doji candle is a reversal type price action pattern because, again, the bears had control of the market, sell, 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 sell. And there was this little doji here where it did pop. Bulls took control for a moment, and then the bears sell, 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 sell. And then the bears ran out of steam. The bulls and the bears were at equilibrium. If we think of it as like tides, right? Like high tide, low tide. Now, when the tide is rising, the rising tide, the water is flowing into the inlet, say, right? And that's moving the water this way. And now when the tide goes out, it's flowing out, right? When we're at, what do they call it? Hang tide, I think it is. When we're at high tide or low tide, the water is stationary, right? The tide's not going in and out because the balance of water going in and the balance of water going out is the same, right? The forces of nature are in equilibrium. That's what we see with doji candles, right? So he's at a neutral, or at a standstill, so we can assume that it's going to go up from there. So those are your 6 core principles. Anyway, I hope that makes sense. We're going to be covering these in a lot more detail in the Pro Trader core curriculum. If you decide that you want to go ahead and proceed with your trading career. But for now, we're going to move on to the actual strategy itself. How do we combine these 6 core principles and actually get a strategy out of them?